Most investors search for complex businesses because complexity feels intelligent. But Warren Buffett made one of his greatest investment in a company built on one very simple idea. Sell insurance cheaper than competitor and still make money. Make sure you subscribe to the channel so we can reach 1000 subscribers. This is the story of GEICO, and if you understand this one business properly, you will understand why efficiency can beat complexity in investing. GEICO was not a fancy technology company. It was not selling a luxury product. It was selling car insurance, a product most people do not love but almost everyone needs. And that is where the real story starts. In insurance, many companies look similar from outside. They collect premium, pay claim, manage risk, and invest in the float. But inside the business, one small difference can create a massive advantage. The difference is cost. GEICO's original model was direct selling. Instead of depending heavily on expensive agent and middlemen, GEICO sold insurance directly to customer. This reduced distribution cost. Lower cost allowed GEICO to offer lower prices. Lower prices attract more customer created scale, and scale made the cost advantage even stronger. Most investors completely miss this. A moat is not always a premium brand like Coca-Cola. Sometimes a moat is simply the ability to deliver same product at lower cost than everyone else. Buffett understood this very early. In 1951, when he was still a young investor, he visited GICO's office on a Saturday and met Lorimer Davidson, who explained the business model to him. Buffett realized that GICO had something very powerful. It was not complicated, it was discipline, it was efficient, it was focus. But here is the shocking part. GICO also faced a major crisis in 1970s because of poor underwriting and aggressive growth. The company almost collapsed. Many investors saw only disaster, but Buffett saw something different. He saw that the core cost advantage was still alive. The mistake was not permanent damage to the business model. The mistake was poor execution. This is a very important investing lesson. Temporary problem in a strong business can become an opportunity, but a weak business with no advantage can become a value trap. GEICO survived, improved underwriting, and later became one of most important part of Berkshire Hathaway. In 1996, Berkshire acquired the remaining GEICO stake for around $2.3 billion. Over time, GEICO became a huge auto insurer in America and major source of insurance float for Berkshire. Now understand why float matter. When customer pay insurance premium today, the company may pay claim later. Until that money is paid out, the insurer can invest it. If underwriting is disciplined, this float can become a powerful source of capital. But this works only when the company does not lose money carelessly on claims. That is why low cost alone is not enough. Low cost plus smart underwriting is the real engine. And this changes everything. In India also, we see similar business lessons. Companies like DMart build power through everyday low prices, tight cost control, efficient stores, and disciplined expansion. They did not win by looking glamorous. They won by being structurally efficient. The same principle applies in banking, retail, insurance, and even manufacturing. The lowest cost operator can survive price war, protect margin, and keep growing when weak competitor struggle. But there is one warning. Low cost is powerful only if it is sustainable. If competitor copy it easily, the advantage disappear. If pricing became irrational, profits suffer. If claim rise faster than premium, insurance became dangerous. So GICO teaches us a balanced lesson. Efficiency is not boring. Efficiency is power. Complexity may impress people, but simplicity with discipline creates wealth. Buffett did not love GICO because insurance sounded exciting. He loved it because the business had a clear cost advantage, a large market, recurring demand, and the ability to generate float. The key takeaway is very simple. Before investing in any company, ask one question. Can this business deliver better value at a lower cost than competitor for many years? If yes, you may be looking at a real moat. If no, you may be looking at a story. Like this video, subscribe to the channel, and comment below which business you think had the strongest advantage today. Make sure you subscribe to the channel. Thank you very much. Bye bye.